Howdy, Jacob here. Today we're looking at benchmark electronics in the electronic equipment, instruments, and component industry. 1.4 billion market cap, essentially the same enterprise value. Looks like they offer product design, engineering services, founded in 1979. Growth is relatively flat over the last 10 years, but up quite a bit since COVID hit. You're looking at, they've been paying a dividend for the last 6 years. Hasn't really increased very much. Return on invested capital, not so great, so maybe that dividend makes sense. They don't really have great ways to reinvest it to give great returns to their shareholders. Balance sheet shows 277 million cash on hand with 4 million short-term debt, 327 million long-term debt. I mean, it's roughly flat, no concern there. Balance sheet is pretty. Ooh, okay, so free cash flow, not as consistent as I would have expected. Maybe we're looking at, I mean, you're including the plus 200, minus 200. Let's be generous and say it's about 80 million average. I think that's fine. Use of cash, dividend pays out maybe a quarter of that, quarter to 30%. Otherwise, they've just been increasing their cash balance, it looks like. I don't know how it's going down, really. Because, let's see, they issued debt here. Oh, because they didn't. Oh, I forgot they didn't make money these 2 years. Okay, so that makes a lot more sense. So they stopped their share repurchases when they stopped making money, but they're starting to make money again. So we'll have to see what their capital allocation looks like beyond this. I think if they get back to making this $100-200 million more consistently, I'd be interested for them to reinvest, possibly make acquisitions, maybe buy back shares that are cheap, or maybe just increase this dividend. I mean, you don't have a great return on invested capital. It doesn't look like growth rate is very high. So that could be their best way of capital allocation. I mean, I'm going to be pretty cheap with this one. I just don't think it's the best company out there based on everything else I've looked at and what I'm seeing here. So I think maybe 2%, maybe buy it for 11 PE. Maybe seems low to you, but look at these margins. Look at that return on invested capital. For an electronics equipment industry, that's just crazy to me. Maybe 2.53. Let's see, share change. What are we looking at? Nothing. 13 million stock-based compensation. I mean, yeah, let's just say they offset stock-based compensation. We're saying the company needs to fall 6-9% before you get the return we're looking for here. This is not the best company that I've reviewed. I would definitely want to get the company like this very cheap. I don't think you're going to get a lot of growth from anything except for the dividend paid and share repurchases, since it looks like, at least for me, what I'm seeing from the numbers, reinvesting back in yourselves, making acquisitions has just not been the most advantageous for them. We hope you enjoy the video, Grace.